why is there inflation? There's inflation because it's necessary. It's necessary to keep this whole system going. And, we live in a system of debt, borrowing, and leverage, and we've got to keep it going. And that's just the bottom line. And it's going to keep going until it doesn't.
James Lavish, founder and co-managing partner of the Bitcoin Opportunity Fund, director at Strive, and author of the popular financial Substack, The Informationist. It is so wonderful to welcome you back to the show. Great to see you again, James. It's been way too long.
Well, it's good to be here, Julia. Always fun to talk to you. So thank you for having me.
I know. And the last time we had you was late last year. So I can't believe it's almost been a year since we've had you. And you are one of these guests that our audience absolutely loves. So I apologize that it's been so long. I don't want to let that happen again. But since it has been about a year, James.
It's probably been my fault. I've been a little bit busy. That's for sure.
That's a
Launching
good
the hedge
problem.
fund and all that.
Yeah. And also in high demand too. But since it's been a year, let's start where we always start, James. Big picture, macro view, where we are today as it relates to the economy and the markets. What's been on your radar lately? What are you paying attention to? And more of your outlook. And as you know, James, you can take all the time you need to set the table when it comes to that big picture macro view.
Well, I mean, big picture recently, people have been on edge in the markets trying to figure out a few things. First of all, we started out in this late summer and going into the fall, just trying to figure out where the Fed was, what they're thinking. And that really drives the liquidity of the markets and access to capital. And so that's been on everybody's mind. And as we come into the fall, you have a Fed that is battling like two different opposing levers that they're supposed to be, or opposing mandates that they're supposed to be overseeing. And so, for your listeners who don't know what those mandates are, it's stable pricing and full employment. And stable pricing is the 2% inflation rate. And they're trying to get inflation down to 2%. And they're having a hard time doing it. Earlier in the year, they were kind of blaming the Trump tariffs for causing the uplift in prices and that kind of persistent inflation. And now they're realizing that that's not really the case. That inflation's just kind of stuck here somewhere around 3%, give it, up 0.25% or down 0.25% from there. It's just kind of been stuck there. You saw it come down from that. It spiked up when the Fed, printed $5 trillion and, that money went into the market via a lot of QE. And then the government sent people checks and there was a lot of spending, and then you had supply chain issues. So prices spiked up 9%, on average. I mean, we all seen the prices of in the whatever it is that you have in your monthly budget, but call it health insurance, car insurance, house insurance. Your groceries have gone through the roof. So everybody's been kind of frustrated about that. The Fed knows it. So prices spiked to up 9%. Now the inflation's down to about 3%. It's just kind of held steady there. You could see it come down, just kind of held steady around 3% continued inflation. It's been persistent. At the same time, you're now seeing the jobs market kind of get tripped up here a little bit. And you saw about 1 million jobs were taken out of the equation that the BLS had originally, the Bureau of Labor Statistics had originally reported at the end of Biden's term, all the way into the beginning of Trump's, and they had to revise those numbers down. And so, there's some frustration around that. How good is the data? How badly is the data lagging? How much is the Fed lagging the data? And now you've got the Fed battling these two different mandates. They've got the stable pricing and they've got the full employment. We don't know what full employment is. It's just a kind of check the temperature of the country. Let's see where it is. But it's what they're really afraid of. What everybody's concerned about is, are we entering a period of stagflation where prices continue to rise and the economy rolls over. So that's kind of been on everybody's mind. And right as all that happens and the Fed comes into the fall and lowers rates, we have a government shutdown. So that government shutdown has now kind of taken liquidity out of the markets. You know, the what happens is the Treasury continues to issue debt and draw money out of the markets, draw it out of reserves, bank reserves. And, you know, they can't spend it. It just goes into their checking account. It sits there. So that's kind of been this overarching issue that people have been watching and wondering when it's going to be resolved. Apparently, it's going to be resolved today with the House meeting. We'll see. The Senate has already passed a continuing resolution to get the government up and running again. But, you know, and apparently that the House is going to follow suit, but you never know. So I'll believe it when I see it in the headlines and it's actually done. But that's kind of just big picture what's been going on. At the same time, you had the markets rip to all-time highs and kind of stay there. And you've had gold rip to all-time highs and back off a little bit, but it has been strong. It continues to be strong. Mm-hmm. And that tells you that there's a few things going on. You know, it's trading at about $4,200 per ounce today. And that's telling you a number of things about not just the economy, but about foreign central banks and foreign entities, what they want to own. And is it U.S. Treasuries? Is that the global reserve asset, or are they starting to turn to gold? And how much of that gold pricing has to do with uncertainty in the markets of everything I just talked about? So that's kind of the big picture where we've been for the last few months and where we're at today.
Yeah. Just so folks know, James and I are talking on Wednesday, November 12th. It is 2:12 p.m. Eastern time, and there is going to be a vote. Supposedly there will be a vote underway in the House on whether or not we will end the government shutdown. But this conversation will still be relevant even if that does happen, based on what we're talking about. I want to explore something with you. You wrote a great piece in your Substack, The Informationist, about a concept most people have never heard of, which is the Treasury General Account. Yet you call it potentially one of the most important macro concepts right now. And I know in that piece, you also did talk about like the government shutdown too, I guess like maybe exacerbating things, but could you explain the TGA, why it's so important, this kind of like government checking account, if you will, why it matters more than most Fed policy decisions?
Yeah. So when you heard Fed Chair Powell last week or 2 weeks ago now talk about where bank reserves are and liquidity and all that, he admitted, he said, look, we're going to lower rates. I can't guarantee we're going to continue lowering rates, but we're concerned. We're not concerned yet. The bank reserves are still ample on their measures, but they're getting to a point where they think they're going to have to start adding liquidity. Okay, so what is he talking about? Well, one of the main issues that has been out there is that like I said, the Treasury, look, the United States we're running multi-trillion-dollar deficits. We spend so much money that we need to borrow more to spend to just pay down the maturity of other debt. Like when debt matures, we don't have money to pay, to give to those investors. We have to issue more debt, to pay down that old debt. Okay, so why does that matter? It matters because the Treasury continues to float bonds. Okay, and as they're selling these bonds, they're getting cash, and then they get that cash and they have to put it into their checking accounts. It's called the Treasury General Account. And that's where they write the checks, wire the money, send the money to all the people that they employ and all of the agreements they have with contractors, like defense contractors, to build, whether it's items for defense, whether it's airplanes or submarines or whatever it may be, aircraft carriers, or much smaller items. That's where that money comes from. It comes out of the checking account. So the Treasury issues bonds, they get cash, they put that cash in the Treasury checking account, the Treasury General Account, and then they use that Treasury General Account to spend the money. So what has happened? Well, for over 30 days now, the government's been closed. So they haven't been able to spend out of that checking account. And so why does that matter? Well, it matters because they have a target. Every single quarter, they have a target of where that general account should be. And sometimes they'll let it build up and sometimes they'll spend it down. Okay, so the exact opposite happened back in June of 2023 when we had the government shutdown. And the government shutdown where I'm sorry, when not the government shutdown, the debt ceiling crisis, when the government was still operating, yet we couldn't issue any more debt. Okay, so here we have a government shutdown. We can't spend money out of the Treasury checking account, the Treasury General Account. Back then, we had a debt ceiling crisis where we couldn't issue any more debt. So we had to spend all the money out of the general checking account, the general account, the Treasury checking account in order to pay the bills, right? So back then they were paying. You said that you saw the debt just stayed constant because they couldn't issue any more debt. But the general account was drawn all the way down. Okay, so that money went into the market during that time, and they were not drawing capital out yet. They were not issuing more debt and taking money out of the capital markets. So it was that in and of itself was an injection of liquidity. So they weren't taking money out, but they were putting money in. Okay. Now the exact opposite is happening now. So now the government shut down. They can't write checks, but they continue to issue debt because that's what they're on. They stay on target and they keep issuing the debt because they know they're going to need this money to eventually make up for all those fees and expenses and paychecks that they've just been on hold for the last month and change. They know that. So they're building up the general account. And in doing that, you've got money that's stuck there. Their target is $850 billion. And right now it's running just under $1 trillion in there. So they've got just under $1 trillion that's just sitting in that account. That tells you that there's over $150 billion sitting there that's waiting to be spent and that people are waiting for. I've got my brother-in-law he works for the government here in Nevada and he hasn't been paid. He works in intelligence, and he's a necessary personnel, and he works in defense, but he has not been paid in weeks and weeks and weeks and weeks and weeks. So that's just been one of the examples of he's not able to do things that he would normally do, whether it's investing or buying certain things or going on trips or whatever. That's it puts a crimp on that, or it forces him to use credit cards to do that. So that's kind of just one of the examples of the issue that it's causing. And so that general account, it's so important because as it's just locked up. That means there's less liquidity out there. Remember, the Treasury is still issuing bonds. It's still issuing debt. And so the liquidity is coming out of the system, but it's not going back in right now. And that has weighed on it a little bit.
This episode is brought to you by VanEck Rare Earth and Strategic Metals ETF, ticker symbol REMX. Rare earths are the hidden backbone of modern technology and defense, powering everything from smartphones and electric vehicles to fighter jets and wind turbines. VanEck recognized this early, launching the Rare Earth and Strategic Metals ETF, ticker symbol REMX, 15 years ago, well before supply chain security became a global priority. Today, China dominates the production and refining capacity of rare earths, creating real challenges for global supply chain security as these materials are essential for technological innovation, clean energy, and national security. That's why countries all around the world are racing to build their own supply chains and reduce reliance on China. As this global shift continues, investment in the rare earth ecosystem is growing rapidly, from mining to advanced manufacturing. Investors can gain access to this powerful trend through REMX. Visit vaneck.com/REMX Julia to learn more. Just to recap, as you point out, the bank reserves are the lifeblood of the financial system. And when the TGA goes up, bank reserves go down, financial conditions tighten. TGA goes down, bank reserves go up, financial conditions ease.
Right.
And that massive amount, just under 1 trillion, is because of that shutdown effect. So if let's say we get through the shutdown and they have some sort of, I guess, a continuing resolution or something. What do you think happens? Like, what does that mean for the economy right now? Because I know liquidity is super important. So, like, I guess, where are we today? Where could we be headed? How are you thinking about it from more of the economic outlook?
Yeah. I mean, well, one of the things that people they've been concerned about, and that Powell said, is that those reserves the bank reserves are coming down. And part of that is because the TGA, like we just talked about. It's because the Treasury is still issuing debt, and that's drawing down reserves as money comes out of reserves to buy that debt. Some of it. It means some of that comes out of foreign entities and hedge funds and all that stuff. But that's part of it. But when that money comes back in, when the government gets up and running and this money starts being spent, then those reserves kind of shore up a little bit. The issue that people have been talking about recently, you've heard maybe on Twitter, is that people are concerned that we're going to get into a 2019 style lockup in the overnight borrowing market. Okay, what do I mean by that? And this is something that I'm still I'm wary of. I'm not raising alarm bells, but making people aware of it, that this is a possibility, and the Fed is well aware of it too. So what am I talking about? Back in 2019, there was something called it was a repo crisis. It was called the repo crisis. Yeah. Okay. And this is before we had lockdowns in 2020. You'll remember this in 2019, September 2019, the repo markets locked up. What do I mean? Well, the repo markets are where banks and financial firms lend to each other. And they do that by they have collateral, and that collateral is US Treasuries. So if I'm a hedge fund and I need, short-term liquidity to meet a margin call or something like that I know is going to be cleaned up in a day or two, what I might do is, instead of selling things, I might take my treasuries and loan them to JP Morgan, and JP Morgan gives me cash. So I actually am borrowing cash using those treasuries collateral, and I'll pay them an overnight rate for that. And that rate is basically, back then in 2019, it was LIBOR plus a spread. Okay. So, and that spread would be, it would be a little bit above the Fed funds rate. Okay. Basically, just to keep it very simple for everybody. Back then, though, what happened is you had this convergence of factors that created a crisis of liquidity and a shortage of dollars. So what happened was the Treasury came out with a larger quarterly refunding announcement. Like they're going to issue more debt than people expected, than banks expected and investors expected. That was number one. Number two is September, and all these companies had to make their tax payments. So they drew down cash reserves and cash balances out of their treasuries to send to the US Treasury. And so that money came out of their accounts, which drew down reserves. And then the third thing is you had currency issues, and overnight or overseas, you had a demand for dollars that were not being met. So all these things kind of came together in 2019, and overnight, the cost to borrow dollars in the United States for overnight spiked all the way up intraday to above 9%, which was just insane. Like, with the borrowing rate should have been down, a fraction of that. And it tripled overnight. And so, and the market's pretty much locked up. The Fed nearly panicked. Well, they did panic. They stopped QT like immediately, and almost within hours, they turned around and started using QE, meaning they started injecting liquidity into the markets by buying T-bills themselves and short-term treasuries themselves. And that put money into the markets. And so people will say, well, they were saying, well, is this QE? And the Fed said, absolutely not. This is absolutely not QE. It's not QE. But if you go back and you look at the balance sheet of the Fed, you'll see that all along the way from the great financial crisis, they were contracting. So all the bonds and mortgage-backed securities, they were taking off. This is called QT, quantitative tightening, when the Fed sells their treasuries and mortgage backs into the market, their balance sheet comes down, the assets they hold. And then you get to 2019 and it starts to tick back up again. You get this little hump in this QE style hump of them buying back $400 billion worth of treasuries. And then they never sold them back out because they turned around and boom, an absolute bazooka of liquidity from the Fed during the 2020 crisis, and they took in another $5 trillion. So that's a long way of saying that they were really worried that so what happened though back then is that the bank reserves fell to a point that was a percentage of GDP or a percentage of total bank assets that made them not ample anymore. And so now that measure, if you look at GDP, is somewhere around 8 to 10%. They start to get nervous, right? So back then they fell to, I think it was 7.7% of GDP. Today they're under 10%. The bank reserves are under 10% of GDP. So it starts to get them, they're on notice. They're not nervous yet because it takes a while for the bank reserves to draw down. They're not nervous yet, but they're on notice. So what was their response? Their response was, we're stopping QT in December. That's the first step. We're going to stop QT because bank reserves are falling to a level that we're starting to take notice. Not really worried yet. And then at the end of the month in October, you had a few things happen again, where you had the government shutdown, the bank reserves fell, dollars were in shortage, and the SOFR rate started to tick up again. It didn't take off like it did. So I'm sorry, let me back up. The SOFR rate replaced
LIBOR.
Rate.
Yeah.
So that's the new overnight rate.
Okay.
So the SOFR rate now is the new overnight rate. It started to tick up, and you're seeing it start to pick up gradually here. And it, on average per night, it's been ticking up. Now it's come back down a little bit, but it's been ticking up. And that's what's been concerning people and concerning investors and saying, are we going to have another 2019 style meltdown in the credit markets and overnight lending market because of, a shortage of dollars and the SOFR rate? And so that's kind of what people are looking at now. It got up just right at the end of the month. There was $50 billion that was borrowed overnight at the end of the month, which was like, whoa, that was not normal. And I'm going to send you a chart so you can put this up when we're talking about this. But you can see here, unless I can actually share.
Yeah, you can share your screen.
Yeah. You can see here that getting toward the end of September, beginning of October, this is the amount of borrowing that financial firms are doing overnight. Which is that repo, right? The repo market, where they're using their treasuries to borrow dollars. Well, it started getting a little bit here. You start saying, it's starting to get active here. And then boom, one night on a Friday night, on October 31st, it exploded. And a bunch of this happened in the afternoon session, where it was like a scramble for dollars. So at the same time, you had this is the spread between the SOFR and Fed funds, or the IOER, which is the overnight rate. So the blue line. So, but you could see here that the spread exploded too. It was, 36 basis points over what the Fed funds rate was. This is what banks are charging each other and financial firms are charging each other for that short-term overnight lending. boom, it exploded up. And people are like, uh-oh, is there a problem? Is somebody imploding? Is there a crisis? Is there a liquidity crisis? What's going on? Well, I think we've all figured out that the problem is the Treasury General Account is, $150 billion sitting in it that has not been put out back in the market. And everybody's waiting for the government to reopen. Well, it's kind of, and that end of month window dressing happens with financial firms because they have leverage ratios they have to meet, and have to make sure that that the statements they put out and the reports they put out are in line with expectations. So sometimes they need more dollars in their account and fewer treasuries, and so they'll do this where they're back here they'll borrow a whole bunch, and because there was so much that was needed. Well, the ones who had the cash were said, well, you're gonna have to pay up for that. And so they started lending them at higher rates, which is kind of what happened there at the month end. And since then it's calmed down. However, do notice that even though it's calmed down, it hasn't come back down to the normal, 10, it hasn't come back down to the normal, like right on the Fed funds rate or a little bit less, because you're using a collateral. So it's like a riskless offer for somebody to give you dollars for these treasuries. You have their treasuries. If they walk away, well, you've got full coverage, and with a treasury, you're not going to lose money on that. But you'll notice here that it's still in this uptick here, that it hasn't completely subsided. And I think part of that has to do with the fact that, going back to your original question, you've got all this money sitting there idle in this Treasury General Account that's not being used. It's fewer dollars out there in the system, and that's been, that's kind of been, it's contracting the liquidity out there.
This is so fascinating, James, and I love the charts. Question for you: you mentioned the Fed and I guess ending QT. What about doing QE again?
Yeah. Well, so in his statement, Powell said, look, we realize that the banks are going to start needing liquidity. It's just a natural phenomenon of an inflationary environment that we live in. GDP rises, nominal GDP rises. And so you need more reserves in the banks for that velocity of capital that's moving around the system. They know that. And so what he said was, we understand that we're going to, we are at a point where in the not too distant future, I'm paraphrasing, but this is the essence of it. In the not too distant future, we're going to have to start adding reserves back. Well, everybody said, oh my God, that's QE, that's QE, that's QE. It's not quite QE yet. It will be added liquidity though. And whether they take that back out of the system is very unlikely to me. So in essence, yeah, it's QE, but it's not the fire hose that we saw in either 2008 of $1 trillion or in 2020 of $5 trillion. It's not that yet. I would say it's more like a steady, it'll start as a trickle and maybe a steady stream of liquidity, billions of dollars a month, but not hundreds of billions. It's going to be a little bit different. Now that all of that is taken off the table, if we have some sort of credit event, which we could see. And the reason we could see that is you just saw today that commercial real estate loans, the default rate has spiked to basically an all-time high since the great financial crisis. And I'm not sure if it's even above that now. I saw a headline before I jumped in here, but they're rising rapidly. And so you saw two auto-related companies, financial companies, go bust in the last number of weeks. You're seeing
First Brands
default.
Yeah,
exactly. And the one
Tricolor,
down in,
is it Tricolor,
the one down in near the border. That's right, in Texas. Subprime lending, basically. Now, what's important about that is that you're also seeing subprime defaults on the rise for autos.
Yeah,
and
I saw a headline before we got on. Yeah, from Bloomberg, right?
And so that's a concern, is how strained are consumers, which gets us into the next part of the conversation. All feeds back again to the Fed and what Powell was saying in his press conference, which was, we understand that we basically have a K-shaped economy. Well, what does he mean by that? He means that, as we get the recovery in this, since the 2020 crisis and since the Fed has been lowering rates, the recovery is K-shaped, meaning that you have a demographic that's top heavy, say the top 10%, that has been doing quite well, even though there's been high inflation. And the reason for that is asset inflation. So you've got consumer inflation and asset inflation. The asset inflation means the price of your house is going up, the price of your gold is going up, the price of your stocks are going up. You've got this asset inflation where you're benefiting from inflation at a much faster rate than you're being hurt by the consumer inflation, because consumer inflation is not as big of a percentage of your either assets or income. The lower demographic, on the other hand, has been struggling, and they've been struggling to make ends meet because you see it every day in posts on Instagram or Twitter that how am I supposed to make it if I can't pay my rent, if I can't pay my job, if I can't pay gas for my car to get to my job, or the insurance on my car, or my health insurance, or my house insurance, or I can't pay for all the groceries. You're seeing this in the lower demographic has really been struggling, and that this is true because the default rate on credit cards is rising with the lower demographic and the younger demographic. And the usage of credit is rising rapidly. And so that is a concern. And so the Fed is trying to weigh this out and say, well, if we lower rates, is that going to help the lower demographic or not? How is that going to help them if we have stagflation and long-term rates stay high? Because it's not going to lower their credit card rates or their mortgage rates, which means it's not going to lower their rent rate, because everything's keyed off the 10-year Treasury. So if the 10-year Treasury remains high because of expectations of inflation remain high, then what happened, just like what happened back when Biden was about to end his term, and the Fed turned around and lowered rates by 50 basis points. Well, what happened? The 10-year rose by 50 basis points. So why did that happen? Because people said, you're lowering rates now? And while inflation is still above 3%, it's 3.5%, you're crazy. The inflation's going to rage. So the 10-year Treasury yield went higher as people sold 10-year Treasuries saying, I need more protection against inflation. I need a higher yield. And so that's kind of what the worry is here. Do I lower rates? Do I inject liquidity? If I'm Powell, how do I get out of this? And the answer is he doesn't. He's trapped. He's absolutely trapped. We are running massive deficits. The Treasury needs him to lower rates so they can lower the coupon that they're paying every year on this $38 trillion of debt that we've amassed. And, and when you do that, it's inflationary. Both those things are inflationary. And so lower rates and continued deficits, which is what we get back to on, this fiscal driven economy that we live in. And so that's kind of the worry there, is that you've got this K-shaped recovery where, if you look at the consumer and you look at actually the two different demographics, and I posted about this recently, and I'll bring up the poster so you can see it, but the two different demographics and just how stark a difference it's been for the wealthiest demographic versus the less wealthy. And here's the net wealth of the top 1% since 1990 versus the bottom 50%. And you'd say, well, Bottom 50% hasn't done that bad. Look at how big this white space is here compared to this way. It's done actually pretty well. But remember, this is the top 1%. Okay. So when you do out the math, the top 1%, here are the metrics. So per capita, the top 1% per person went from $1.8 million of net wealth to $15.5 million for a $13.6 million gain. That's an 8x multiple. The bottom 50%, remember, they're sharing all of that, right? They're sharing all the bottom 50%, you have 50% of people sharing this. So according to the demographics and the census from back in 1990, the bottom 50% on average had $5,700. By the end of 2025, they had $25,000 for a $19,000 gain. So they made 4x. They've gained 4x in wealth, half of what the top 1% did. So it's just getting worse. And that's really the concern here, is that we've got this, separation of wealth that's occurring because of the way that our economy is driven and the debt-driven economy, that if you don't own assets, that you're being left behind, which gets all the way back to everything that we talk about every day and preach on owning gold, owning Bitcoin. I prefer Bitcoin, long-term. And this is what I write about in the Informationist every week, is just how and why you should be owning assets and explaining in all the different things that are going on in the economy for people to understand that. And it's why we launched the Bitcoin Opportunity Fund. David Foley, my partner, and I we are extremely confident. I have super high conviction in Bitcoin as an asset and as a base layer for an economy that we need. And it can help the smallest and the lowest demographic. If you can just put away any money and you can buy a fraction, 1/100 millionth of a Bitcoin to start, it's just, there's something there for you to buy that cannot be debased. And that's why we did this, is that we really believe in this system and in Bitcoin in the future. So
yeah, I want to quote something that you wrote, because you said, when you flood the system with dollars through the Fed balance sheet expansion, through TGA drawdowns, or both, each dollar becomes worth less. Nominal prices rise, not because assets are fundamentally more valuable, but because the measuring stick is shrinking. Gold doesn't go up in dollar terms because gold changed, the dollar fell. Bitcoin doesn't rally because Bitcoin changed, the dollar got debased. Real estate doesn't appreciate because the house improved, the currency deteriorated. This is why I stay positioned in hard assets, Bitcoin, gold, real estate, with pricing power. Not because I'm bullish on the economy, but because I'm bearish on the currency. The TGA drawdown is coming. It's mathematically inevitable. The government has to spend. When it happens, especially if it coincides with the Fed balance sheet expansion, the liquidity wave will be substantial. Don't mistake liquidity for prosperity. Position for debasement, not the narrative. If you are like me, you will buy hard assets and hold them forever. I think that's such an interesting point, James, because I think a lot of times people think liquidity, they think it might be a good thing, like prosperity, if you will. But you're talking about like the debasement of the currency, the dollar.
Yeah. And, one of the things that confuses people is that, I ask any of your normal friends that are not neck deep in this stuff and talk about inflation. I do it all the time. I say, well, what do you think inflation should be? Like, what should the inflation rate be? And they say, well, I think it's about like 2%. That's good. And it makes you, because if you don't have 2%, then people will hoard their money and then it'll grind the economy to a halt because they won't spend and buy things. And they've been brainwashed into really, truly believing that inflation is normal and not understanding that with technology, we should have deflation. We should be getting everything for less.
It wasn't 2% just like a random number like someone came up with? Did it come out of like New Zealand or something?
It happened. Well, some people talk about it matches the rate that of gold extraction, but really, the best explanation I've studied or heard is that the New Zealand bank came out with it in the 90s and everybody just gravitated to it. Now, why would it be 2%? It's a good question. If inflation is 5%, you're going to feel that because in just 2 years, your spending, your purchasing power is down by 10% if your wage hasn't kept up. You know, so in 5 years, it's down 25%. Everybody felt it in COVID. The official reading for inflation during COVID is that from 2020 to 2025, you lost 25% of your purchasing power. Now, you and I know that that's probably understated.
Wait, can you repeat that one more time? How much purchasing power have we lost?
From 2020 to 2025, you lost 25% of your purchasing power. That's how much inflation was.
Yeah.
And that's the official number. So now think about it. Let's go back to first principles. Why do we have inflation? Well, we should have deflation. Let's start there. With when I was a kid, I'm a little bit older than you, but when I was a kid, I used to go into Tower Records or Strawberries to go buy a CD, and it was like $12 to $15 for 9 or 10 or 11 songs at most, if they had a second LP on there. And now for that $12 or $15, I've got a phone that $12 or $15 a month, I can get millions and millions and millions of songs at my fingertips at any time from any artist I want, basically. That's deflation. Photos, I used to go and buy a roll of 20, 24 photos on an actual piece of film, like a roll of film that you put in a camera. And that was it. That's all you got. Then you had to take that film and go down to they didn't do this.
Oh man, there's so much nostalgia in this. I remember this.
Photoshop. Yeah. Yeah. You had to spend money to get them made and get them printed. And
it was fun to open them and flip through them and see how they came out.
Yeah, you remember that. Yeah. So, but that's now I can take 24 photos in like just holding the button down in a second or two. It's like, it's crazy. Or all the video you can take with that. I mean, the video cameras, you remember the old like home video cameras that people had at weddings and baby showers. Everybody's got iPhones now or their Samsungs or whatever. That's deflation. Everything should be going down in price. Why is it going up? Well, you could say, well, there's more technology in there. It costs more to make the chips. All that. Yeah, but okay. But if you're making the same technology year after year after year, it should be going down in price. Everything that we innovate on should be going down in price, and because it's getting better for less. You're all this technology and innovation makes it easier to make these things for fewer people, less labor and materials and all that. So anyways, but on the flip side of that, now let's talk about why we have inflation. Well, we have inflation because we have an expansion of the money supply. Basic terms. The money supply has been expanding at somewhere around 7.1% since 1971. What happened? Well, what happened is we got off the gold standard. We had the Nixon shock who said, we're officially off the gold standard. You can't turn in your US dollars for gold anymore. Sorry. But trust us. You have the full faith of US government that backs this US dollar. And then you got all these countries to agree to it. And so the US dollar is the world reserve currency. Okay, so put that aside. So now we have this dollar that there's nothing it's attached to anymore. So what do? Well, we run deficits. We run deficits and we borrow money. We keep borrowing money every single year. And in doing that, and with the way the bank works, you expand the money supply. So the money supply has been expanding at that rate, 7.1% since 1971. That's one measure. I've seen others, 6.8, 7.3, somewhere in there. So as the money supply expands and it goes after these goods, the goods that are hard assets, things like gold, now Bitcoin, when you have a house the houses aren't appreciating in value. The dollar that's being bought with is the depreciating in value. There's just more and more and more of them chasing after that house. So that's kind of what's going on. And why do they need this? So let's get down to the first principle of why they need this. Well, we need inflation because of that deficit. We've got $38 trillion of debt. So what, if you look at just that and you start pulling it apart, you say, well, what's the solution? Well, the problem is we'll use big numbers and just round numbers here. They're changing from year to year, but this is about what we're talking about. The US government spends about $7 trillion a year. The problem is we only take in about $5 trillion in taxes. So it's a negative of $2 trillion. All right, so you say, well, we can just cut spending. There's a few problems with that. Number one, structurally, it's very difficult to cut because the vast majority of that $7 trillion or of the $5 trillion that you make, the vast majority of that is taken up with Social Security, Medicare, Medicaid, and defense spending. And then the last piece is interest on your debt. Okay, so that already takes up all that $5 trillion. So even if you cut out every single other program, every single other discretionary expense that's not signed into legislation, you're still probably running a deficit. That's number one. Number two, it's just very it's unpolitically it's unpalatable for politicians to cut expenses because they have to serve their demographics. So we're witnessing it right now that the Democrats want to spend ungodly amounts of money to shore up their demographic, whether it's an extra $1 trillion for, illegal aliens because they need those votes, or it's just wasteful spending for demographics that, that they're going to get either political donations or just their vote from. It's not just the Democrats either. It's both parties. The deficit, the debt rises under both parties. Make that clear. But nobody wants to cut spending. It's political suicide. So the second thing you do, and it just doesn't happen. The cutting doesn't happen. You saw what happened when the Doge Commission was created, and the spending was cut on just either fraudulent or just ridiculous packages and programs. Man, people got violently angry about that because they didn't want their programs cut. So it's just unpopular politically. So they don't want to do it. Now, they try to trick each other into doing it, but it's hard. So it doesn't happen. The second thing that you could do is you can raise taxes. Well, raising taxes might sound great, but as you've seen in different European countries and the Nordic countries, you raise taxes on the rich, you wind up having rich flee your country. And so that's one thing. The second thing that happens, though, is if you're in a country like America, you have innovation that gets stifled because you have companies that stop spending on research and development, expanding productive product lines or, attractive product lines, profitable. That means they're spending less money. They're hiring fewer people, and their productivity goes down. And ultimately, what happens is you raise rates, you get to a level that you're receiving in your tax base, and then that level kind of starts to turn over though, because even though your rates are higher, you're charging higher rates on productivity that's declining, and so you get into a worse spot. It's not a good thing to have raise your taxes on companies and small companies especially. So you wind up in a worse spot. And the third thing you can do is you could just revalue your debt. You can default, which is what we saw Germany made, Greece do basically. And you've seen countries do this where you've seen emerging markets do this all the time, where they just default on their debt. But when you do that, though, that means that you're not able to issue debt in your own currency going forward. You're in the penalty box, at least for a while. And so if you're a country that issues debt that's denominated in your own currency, you would never default. You would never hard default. What would you do instead? You just print money and buy your own debt. We're watching Japan do it ad nauseum. They're the largest owner of their own debt, the Japanese central bank. And so that's what you do. is what you wind up doing is you print money and you debase the currency. Now, what happens when you print money and you expand the money supply? Well, your GDP goes up nominally. So it just goes up in more dollars. So you issue debt in 2025 and, in 2030, that debt, or let's say you issue debt in 2020, right? And in 2025, you're using dollars that are 25% cheaper to pay down that debt. So there's more dollars out there. So by debasing the currency, you can pay down the debt easier or manage it easier so it's not rising so rapidly on you. So that's kind of the that's the great game plan that they have. And so when you go back to your question of why is there inflation? There's inflation because it's necessary. It's necessary to keep this whole system going. And, we live in a system of debt, borrowing, and leverage, and we've got to keep it going. And that's just the bottom line. And it's going to keep going until it doesn't.
Mm-hmm. Yeah. James, it's always great having you on. Let me ask you one final question. I wish I had more time because I have even more questions for you. What is the risk for you right now that's maybe keeping you up at night? It doesn't have to actually be keeping you up at night, but it's not getting enough attention.
Well, the one that is starting to get a little bit more attention is, look, I think the AI is going to be transformative. I think it's going to be massive. I think it's going to be, it's going to be tremendous, and it's going to evolve into something that we can't even imagine right now. I do think that. I do think that these companies that are involved in the AI, revolution, their prices and their stocks have risen so rapidly and so much that it concerns me that it's gotten ahead of itself a little bit. Do I think it's going to crash? And do I think that it's all fluff and it's just, it's not real and it's like a 1999 tech bubble? No, I don't think it's that. I think it's more that it might be a little bit ahead of itself. And it concerns me that if there's a drawdown, it'll just take everything down with it, at least for a short period of time. I don't worry. I'm even though the economy is K-shaped right now, you go out and restaurants are full. People are going out to concerts, they're going out to games, they're going out to sporting events. It's not like it's stopping. You're not feeling like you did back in the great financial crisis when the economy kind of ground to a halt. It was almost depression. You're not feeling that. So I'm not worried about that quite yet. I'm more worried that we just have some sort of shock in the system and that the stuff has gotten ahead of itself a little bit. Now, again, ultimately, I think it's transformative, and all these companies should do very well. But the reason that it concerns me is that, you've got a handful of companies that make up about a third of the S&P. So there's two things there. If you have a cascading event where all of these are being sold off, what happens is because of ETFs, you have so many ETFs that people own rather than the individual stocks, they just start selling ETFs, and then everything's drawn down with it. And so you kind of have an unexpected market shock from that. Do I think it's going to happen? No, I don't. I think it's, a coin flip on whether or not we have a drawdown, and it's a lower probability that we have a massive drawdown. I mean, like, I'm not talking about 25, 30%. That's massive. I'm not expecting that. However, there's a risk of that out there, I think. And because of that, because of the way that the market is structured, with all the leverage that we have, that we talked about, and with the structure of how these companies are owned through ETFs, there is a possibility that we have a sharp drawdown. And when that happens, everything correlates to one. It doesn't matter what you own, even if you own gold, it's gonna go down with it, because investment managers sell what they can, not what they want to. And that ends up being whatever's in front of them. And so My hedge fund, while the Bitcoin Opportunity Fund remains fully exposed to Bitcoin, the Bitcoin Treasury companies, and other stuff, we also have some insurance on the portfolio just in case there's some sort of market shock, because we haven't seen one in a while. And I think that some of the new entrants into this world, they have not seen what I'm talking about in a 2008, 2001, 1999, 1998, that style, 1987. They haven't seen these drawdowns that happen so quickly. So, but I still remain super optimistic. And if that does happen, I think it's a great opportunity, because nothing will stop the reality of the way the system is structured and the need for just constant liquidity, expansion of liquidity and money supply, and debasement of currency, which means own assets. They're just going to continue going up.
James Lavish, founder and co-managing partner at the Bitcoin Opportunity Fund, director at Strive, and author of The Informationist on Substack. So wonderful having you back on the show. Really appreciate you sharing all of your insights, your knowledge, your wisdom, helping us all learn and get better and explore these ideas. Really appreciate you taking the time. Thanks again, James.
Well, it's great to be here, Julia. I look forward to the next time. Thank you.
Likewise. We'll have to do this in 2026 and catch up. Thanks again.
Deal.